Are we recording?
Yes.
Oh, okay, cool. Hello, and thank you for tuning in to today's video. I'm Gayatri from Index One, and I'm joined by Chris McKeffey and Craig Camille from BX. Welcome to Portfolio Strategies Outlook, which is a quarterly content series designed to keep you informed on market trends and evolving investment strategies. Be sure to subscribe to our email notifications so you don't miss the next video. In this session, we'll recap recent market developments, analyze strategies that have been performing well and those that haven't, and explore emerging investment approaches. We'll also highlight new strategies set to be calculated by Index One, where we're committed to supporting money managers by calculating innovative index strategies and providing timely insights into market trends and dynamics. With that, Craig, over to you.
Thank you, G. Yes, this is a quarterly review that we do to review the markets and review performance and review strategies that are working and which ones are struggling. Thought it'd be interesting to go back and look at the chart that we used in early April when we did a call like this. And you may recall that we had quite the sell-off between mid-February and late March, eventually bottoming out on April 8th. We had, and this was an actual slide that we did back in April. Was that movement a blip and things would start going back up again? Was it just chop and we probably would go sideways and there wouldn't be a conviction one way or the other? Or was it the beginning of something more serious like a bear market? Sometimes it's good to go back and look at where we were, and what unfolded, as we'll see on the next slide, was it was in fact a blip. And from that bottom in April, early April, the equity markets have just been off to the races. In fact, the aggregate, the bond market's been off to the races as well. You may remember that back in that dip in the spring, which was largely related to a lot of uncertainty around tariffs, the market has dismissed the tariffs and the risk of inflation and focused on growth, particularly the biggest growth companies from around the world. And now here we are. And so the question when we look at this slide is the importance of a couple things. One is remaining invested. It's easy to get spooked out of the markets. Two is that it's good to have some methodology to increase or decrease your risk. And now we have to ask ourselves the same questions. Are we now heading for a continued bull market? Are we looking for some chop, or are things going to turn down? We don't know, but we monitor this daily. So when things change, we respond in real time versus having to prognosticate. One thing that's different is if you look at a lot of the fundamental macro strategists who look at earnings and earnings growth and large cap growth versus the rest of the equity universe, most firms, the majority of firms are cautious right now because of this move that we've had upward, and it just created overvaluation and higher PEs. So we get that, and we watch that closely. But we also realize that we don't want to adjust an asset allocation until we get confirmation that things are actually going down. So anyway, it's been a fascinating year. It's been very hard to make money. It's challenged portfolio managers. And, we look forward to seeing what the next quarter brings. This was a slide that we did earlier in the year. And this showed the difference between growth value and the S&P 500 for 2024. And again, we think it's important to just take a quick peek backwards. Last year, which was a very strong year, 2024, we saw a huge divergence between growth and value as represented by two popular ETFs. The S&P 500 last year was up 22.3, with growth being by far the place you want to be. So a lot of people rolled into this year, and in fact, we saw value really outperform in the first quarter. And I think most people felt like, all right, value's finally going to have an opportunity to be an outperformer for maybe a cycle or a half a cycle. Well, it really lasted just a couple of months in the first quarter when there was a rush to quality and safety. But once the market turned around in April, growth has really taken off relative to value. So keep in mind on April value was up like 2% for the year and has gone up by another 7%. But growth in April was down like 9% for the year. So really over the last 6 months, growth is up 25 or 30% from the bottom, and value has been steady, but hasn't nearly gone up as much in the last 6 months. And the S&P 500 has gone from negative after the first quarter to now it's having another strong year, up 13%. So this is why we say it's been a challenging year, because it was hard for investors to pick growth, value, stocks, cash, international, US, and just whether or not to trim things at certain times and add things to other times. So here we are, same as we were last year. Like, hey, growth is having a great year versus value. What does the future look like? So again, we watch this very closely. For the moment, we're in a bullish growth market, but that could change any day. So on the next slide, we get a little bit more specifically into the kind of what's worked from a benchmark standpoint this year. What's interesting is the MSCI ACWI ex-US ETF has been, let's just call it international, has been the best place to be this year. Then we see a couple of, ACWI and EFA, benchmarks at the top of this list. What's interesting is that momentum is up 25% and the growth ETF is up 19% year to date. So not only is the S&P 500 turned around and having a good year, but we're really seeing a replay where growth and momentum, which I think a lot of people thought were probably overvalued and maybe slowing down and just needed to catch their breath, in fact, didn't do that and just kind of kept on going. If you look at the bottom of the list, you see that the Russell 1000 value and the S&P low vol, good years, up 4 and up 10, but the SMID and value categories continue to underperform the large cap and the growth. So again, for now, we just think it's interesting to see what these trends look like and where the opportunity is. And for this year, it continues to be in growth and momentum and international. By the way, the international is a new thing, really moving up into the top spot this year. So we've said all year, and we continue to say it makes sense to have diversification through a healthy weighting to international holdings.
Not only is it up quite a bit this year, it's the first time we've seen international leading the U.S. market since time out of mind. Just in the back of people's minds, we might be thinking, is this a paradigm shift underway? But one thing that I think makes this year particularly interesting is if we did this snapshot on April 15th, all of the US equity stuff would be exactly flipped. Like the SPLV was literally the top of this list, and momentum was like -20, right? And then high dividends were right under SPLV at the top, and growth was at the bottom. So it's a complete reversal of what we saw through the first, call it, third of the year.
Yeah, no, that's a great point. This slide is a listing of several of the indexes and or strategies and or SMAs, we all call them indexes, that we run in partnership with Index One. So Index One and BX have become a real player in the calculation of very unique, very good and differentiated investment strategies from around the world. We like to see what we can learn just by looking at our internal strategies. Keep in mind, Index One and BX are really investment platforms, and we're not a third-party manager. So we get a chance to work with 20 or 30 or more of some of the best money managers from around the world and research firms from around the world who are largely quant and systematic, which is why we put them into an index structure versus an SMA or another type of basket. But in the upper right-hand corner, so what has performed in the S&P 5? What has outperformed the S&P 500 year to date? Technology, international equity, U.S. large growth, U.S. large cap equity, and some value and some tactical. If we look at the left, we see a sampling. So BX represents about 65 indexes, of which the vast majority of them don't compete directly with the S&P 500. Many of them have different benchmarks. But we thought it'd be interesting if we just said, hey, as of September 23rd, which ones have actually outperformed the S&P 500 year to date? And we get a list of about 25 strategies, the best is the next gen, but then you jump into international with Europe, then you get cloud, smart alpha, international, and so on. But if you look at the left column where it says category, you can see that, yeah, we've had a lot of U.S. large cap equity strategies outperform the S&P 500, but we're also seeing some value, a SMID, and tactical, not to mention the international. So to us, it's just interesting to see where the performance comes from on our strategies. The bottom left-hand corner, after the first quarter of 2025, the S&P was down 5.1% and value was up 2%, which is that chart off to the lower right. So anyway, we one of the things that we believe is keeping a very, very close eye on actual performance and making adjustments as changes are made versus trying to predict what's going to happen. And you can just look at all the Wall Street research right now and know that there are a million different outlooks in terms of what might happen next with the equity markets. We prefer just to keep a close eye on all the different categories and make shifts and adjustments as we're seeing them play out in real time.
Not really on your observations, but something that I wanted to point out in terms of how BX and Index One can partner with advisors to get them to where they want to be with their accounts. So one of our most popular strategies is the BX US Large Cap Momentum 10. It's been a top performer. It's a top performer again this year, up 22 and change percent. It was a top performer last year. It's just 10 stocks that are driven by a very specific definition of momentum. But there was an issue with it. And the issue was there's only 10 stocks in it, and some of them had very, very high dollar prices. So for our advisor partners that work in a whole share environment, unless your accounts were very, very large, you wouldn't be able to replicate the index very closely because a $5,000 stock is tough to get the right allocation to. So you look 2 slots down and you're not sacrificing much in performance. You'll see the US Large Cap Momentum 10 Index Small, which we custom created with an advisor that we worked with so that we would only include stocks under a certain dollar price so that it would be much easier to replicate the performance of the index. And over time, that index has kept up very, very well with the US Large Cap Momentum 10 Index. Just kind of an indication of how we can work and partner with people to get them where they want to be.
So if we go on to the next slide, Chris is going to walk you through kind of what I've referred to a few times through our talk on this video. How do you make adjustments in a market environment that are unpredictable and can change from one direction to another direction, relatively quickly? So Chris, walk us through this very interesting looking slide.
Yeah, so the box to the left, the vertically aligned box, is a tool that we're gonna make available for free to advisors that we think has tremendous value. So this is not yet publicly published, but it will be within weeks. So at BX, we've scoured the world to find great investment management strategies and ones that have significantly proven their worth over time. A number of these strategies actually have a bit of a bullish, neutral, bearish embedded within them. So what we thought would have tremendous value is, it's great. You can go get the house view of any shop that you want, and you'll get one view, and it's either, risk on, risk off, bullish, neutral, bearish. But we thought if we had 9 different indicators of the US equity market that over the course of time have proven to deliver added value, and we could make those available to you and then combine them so that you've got not 1, but 9 different, time-tested, battle-tested opinions as to what's going on in the market combined in the BX Risk Shield indicator. And as you can see right now, we're very, very much risk on, even though, as Craig pointed out, most fundamental market analysts think that we're, overvalued and it's time to be cautious, et cetera. We're not seeing that yet. These indicators could shift, and you see this, kind of the second part of the box with the curve. What it shows is it was moving much more towards risk off back in March and April, but since May, it's been pretty much almost completely fully risk on. So we think that there's some value to that. And in fact, we've created a model that captures the essence of it to create an easy button for advisors. So what we did is we combined 5 of these different strategies to create what we call our tactical model, which is, I would say, it's a long biased model that has some components that can move to bonds or cash that over time has provided tremendous downside protection in times of significant market stress, and it's kept up on the upside. So that's a nice little portfolio component to add. So you can take these indicators and use them on your own, or you can just buy the model and it's built in kind of for you. The other two horizontally aligned boxes that you see on this slide are kind of a rehash of some ground that Craig's already covered that just shows, momentum is the leading factor, followed by growth, value, and then quality and minimum volatility have significantly lagged, even though that was the complete opposite in April. And then the bottom slide shows you actually emerging markets is having the best year of all, then international developed, then the US large cap, then mid cap and small cap are up 4% and 5% again. So mid and small cap lagging again and again. We still don't recommend building portfolios without an allocation to them because their time to shine will come, but it hasn't been for a while. And it's not this year.
Awesome. Thanks, Chris. And thanks, Craig. That was really helpful. Chris, would you like to also go ahead and introduce some of the latest strategies that are being calculated by us at Index One and are now onboarded onto the BX platform?
Yeah, I'm happy to, G, because we're always, as I said, we're always scouring the world to find new and innovative strategies to help advisors add value to client portfolios. So the first new strategy that I'll mention is the BX ERS 40. ERS stands for Equity Risk Sciences. And what we've done is the team at Equity Risk has been developing a forensic accounting model for over the course of decades, but there's never been an investable product directly tied to this model. And what it does is it really goes deeply into all a company's filings, financial filings, to determine where there's risk. And the model has done a very good job of picking winners over time and an absolutely outstanding job of avoiding losers. So we partnered with Equity Risk to say, okay, why don't we create some investable portfolios that leverage the science that you've been developing for the last 30 years? So this BX ERS 40 is a product that takes the 40 of the top names from 40 of the top ranked A-rated names from the equity risk science universe. Next, we partnered with a Canadian company called boosted.ai to create a couple of strategies. There's a US large cap strategy and there's a more tactical strategy. What Boosted does is that it's machine learning, and what the machine is learning about is which factors are most important to influencing the price of a stock in the next time period, and that time period can be adjusted. And it looks at 55 different, they're not all what you would classically call factors, but you can think of them as factors. And then it compares every single stock in the universe to every single other stock in the universe in a winner-take-all kind of fashion until the portfolio is whittled down to the top 30 or 40, depending on which one of these strategies you're embracing, of those names. So it's a really, really interesting system. Happy to go into it deeper with you should that prove interesting. And finally, we've got the BX Adapt Risk Hedge series. So Adaptive Investments is a great partner to BX. They've been publishing their risk hedge index for, I don't know, decades. And what it is, it's a risk on, risk off, it's graded. So you can be at a 9, 8, 7, 6, all the way down to 1. And it's proven really of high interest to advisors over time. There are thousands of advisors that subscribe to it. But once again, there was never a directly investable product that was tied to it. So we partnered with Adaptive to create an ETF-only version of the risk hedge index, and then an individual stock version of the risk hedge index to enable advisors to once again easily embrace this system that's been so successful for so long and put it to use for their clients. So, G, that's what we have that's new for now.
Amazing. And as always, Index One is proud and excited to partner with BX. and calculate all these very innovative indices. So we're looking forward to onboarding them, which we have, and onboarding new indices that are upcoming. Thank you both so much for your valuable insights today. And to our viewers, you can explore all the BX models mentioned in today's session on both BX's and Index One's websites. In the meantime, be sure to subscribe to Index One's and BX's email newsletters to stay updated on our next Portfolio Strategies Outlook video. Thank you for tuning in, and we look forward to seeing you next time. Thanks, everyone.